Hi, I'm Akshara. I'm here to talk about equity theory. Equity theory is a theory of motivation that suggests that employees' motivation at work is driven largely by their sense of fairness. Employees create a mental ledger of the inputs and outcomes their job and then use this ledger to compare the ratio of their inputs and outputs to others. Stacey Adams' equity theory is a process model of motivation. It says that the level of reward we receive compared to our own sense of our contribution affects our motivation. The theory considers the concept of equality and fairness, as well as the importance of comparison to others. Adams' equity theory calls for fair balance to be struck between an employee's input hard work, skill level, acceptance. The term equity refers to fairness and justice is distinguished from equality, whereas equality means providing the same to all. Equity means recognizing that we do not all start from the same place and must acknowledge and make adjustment to imbalances. Equity ensures everyone has access to the same treatment, opportunities, and advancement. Equity aims to identify and eliminate barriers to prevent the full participation of some groups. Barriers can come in many forms, but a prime example can be found in this study. Equity gives a larger pool of employees equal opportunity to grow into leadership positions, ultimately leading to greater cognitive diversity in leadership positions. This, in turn, makes the company more agile and resilient to market changes and opportunities. According to Adams' theory of motivation, employees who identify a situation of inequality between them and their peers to feel demotivated and distressed. For example, if an employee knows that their colleague is getting a higher salary than them for the same amount of work, this might create dissatisfaction. The key elements of equity theory are input, outcome, and comparison levels. Input refers to the amount of effort that a person puts into a relationship. Outcome refers to the rewards that a person receives from a relationship. Comparison level refers to the person's ideal level of input and outcome in a relationship. Essentially, Adams' equity theory states that people are motivated to put in a fair amount of work based on two factors: their pay, which must be equitable in the first place, their perception of how well they are paid compared with others. Equity theory assumptions apply to business cognitive distortion. The equity theory of motivation deals with the way people compare the value of themselves to others in similar work situation based on their inputs and outputs. Inputs are what you bring to the situation, like your skills, time, and education. Expectancy theory holds that individuals seek to maximize their positive outcomes. In contrast, equity theory posits that individuals seek to find balance between their inputs and outcomes. Equity theory refers to the give and take synergy between the employee and employer. Understanding equity theory is critical because it explains how employees demonstrate their side of the equation and how to organize can overcome equity problems in the management of personnel. Applying equity theory in the workplace. Equity theory can be a model for measuring how satisfied an employee is in their job. According to John S. Adams, your staff try to keep a balance between how much they give to you, inputs, and what they receive from your business. In return, managers can use equity theory to improve worker satisfaction, knowing that every employee seeks equitable and fair treatment. Managers can make an effort to understand an employee's perceptions of fairness and take steps to reduce concerns about inequity. With equity, an organization will recognize that each employee has varying access to resources and privileges, and those with less access may need more support in order to take fair advantage of opportunities within a given company. The basic components of equity theory are outcomes, instrumentally, and valence. The theory assumes that people's motivation in an organization is based on the desire to be treated equally and fairly. When the output or input ratio is viewed as equivalent, then equity is perceived as attained. There is not much motivation to change the situation. Equity theory has several implications for business managers as follows. Employees measure the total of their inputs and outcomes. This means a working parent may accept lower monetary compensation in return for more flexible working hours. Different employees ascribe different personal values to inputs and outcomes. Pursuant to equity theory, individuals are motivated by being treated fairly. Perceptions of fairness is generally a result of social comparison. That is, we compare our efforts, inputs, and results of our effort outputs with the efforts and results of others. It matters because equity theory illustrates the balance between how employees feel about their work and how hard they should work. As a result, in the workplace, the first place where can test this surrounds fair pay. Employees have a responsibility to pay employees fairly. It's not just the right thing to do. The equity theory of motivation is the idea that what an individual receives for their work has a direct effect on their motivation. When applied to the workplace, it means an individual will generally aim to create a balance between what they give to the organization compared to what they get in return. The equity theory of motivation deals with the way people compare the value of themselves to others in similar work situations based on their inputs and outputs. Inputs are what you bring to situation like your skills, time and education. Equity theory is often used in the context of work relationship where people may compare their contribution, example time, effort, skills to the outcomes they receive. Example salary, benefits, recognition. Some of the most common forms of equity include common stock, preferred stock, additional paid in capital treasury, stock, accumulated other comprehensive income or loss. Retained earnings. An example of equity in education can be found in teachers who are able to adapt their teaching style to match a student's learning capabilities. Some students thrive as auditory learners who process information out loud and ask questions as needed. Equity is the amount of capital invested or owned by the owner of the company. The equity is evaluated by the difference between liabilities and assets recorded on the balance sheet of a company.